Imagine this, you've been diligent about paying your bills on time, never missing a payment, yet your credit score isn't as high as you think it should be. Could the mix of credit you have be the missing piece of the puzzle? Diving right into the heart of the matter, the term credit mix might sound like financial jargon, but it's simply the variety of credit accounts you have. This could include credit cards, student loans, mortgages, and auto loans. And here's the kicker. This seemingly small factor actually contributes to a whole 10% of your FICO credit score. That's right, 10%. But why does it matter? Well, lenders and credit agencies like to see that you can handle different types of credit responsibly. It's like a financial juggling act. If you can keep all the balls in the air, it demonstrates your creditworthiness. Now, there are two main types of credit to consider. First up, we have revolving credit, which includes credit cards and lines of credit. These are the types of credit where you borrow a certain amount, pay it back, and then borrow it again. It's an ongoing cycle, hence the term revolving. The other type is installment credit, which encompasses loans, like your mortgage, car loan, or student loan. With these, you borrow a lump sum and then pay it back in regular installments over a set period of time. So, having a mix of both revolving and installment credit in your financial portfolio can be beneficial. It shows lenders that you're not only capable of managing different types of debt, but also that you're experienced in handling the unique requirements of each. But, you may ask, does this mean I should take on more debt just to diversify my credit mix? Well, that's a question that opens up a whole new can of worms. So, having a mixture of credit types can indeed influence your credit score. But how significant is this influence? Is it worth taking on more debt just to diversify your credit mix? Some financial advisors advocate for diversifying your credit mix to boost your credit score. Yet others argue that it's not worth taking on additional debt for the sake of diversification. Who's right? Let's dive in and examine both sides of this intriguing debate. On one side of the spectrum, we have those who firmly believe in the power of credit mix diversification. They argue that having a variety of credit types like credit cards, car loans, or a mortgage can potentially raise your credit score. Why? Because it shows lenders that you can handle different types of debt responsibly. Lenders, after all, are in the business of risk. They want assurance that they'll get their money back. Seeing that you've successfully juggled multiple credit types can make you seem like a safer bet, a more appealing borrower. But let's not forget the other side of the debate. Critics of diversification argue that taking on unnecessary debt can lead to financial trouble. They caution against opening new lines of credit just for the sake of diversification. After all, the impact on your credit score might not be as significant as other factors. Factors like payment history and credit utilization carry more weight in your credit score calculation. Payment history accounts for about 35% of your score, while credit utilization makes up about 30%. In contrast, credit mix only makes up about 10%. So, while diversification might give your score a slight boost, it's not the be-all and end-all. It's essential to remember that a good credit score is not just about having a diverse credit mix, but also about managing that credit responsibly. So, who's right in this debate? Well, it really depends on your individual circumstances. If you can handle the additional debt and manage it responsibly, diversification could be beneficial. But if taking on more debt could lead to financial trouble, it might be best to focus on other areas of credit management first. Clearly, the topic of credit mix is not black and white. It's about balance and responsible credit management. But what can you do if you're just starting to build or rebuild your credit? Starting from scratch or recovering from past credit mistakes can feel like a daunting task. But understanding the role of credit mix can help you strategize. The journey to a healthy credit score doesn't have to be a solo trek up a mountain. Think of it more like building a house brick by brick, with a diverse credit mix being your sturdy foundation. So how do we lay this foundation? First, remember the mantra of starting small. Credit is a journey, not a sprint, and every journey begins with a single step. Secured credit cards can be that first step. These cards require a deposit that serves as your credit limit. They're a great way to show lenders you can handle credit responsibly without the risk of getting in over your head. Next, we have personal loans. A personal loan can be used for any purpose, from consolidating debt to funding a home improvement project. By paying back this loan on time, you're showing lenders you're trustworthy. But what if you're finding it hard to get approved for a loan or a credit card in the first place? That's where credit builder loans come in. These are loans where the lender deposits the loan amount into a secured savings account. You make payments over time, and only after you've paid off the loan in full, you get access to the money. It's like a forced savings plan that builds your credit. Crucially, in this journey of building a diverse credit mix, always remember to only take on debt that you can afford to pay back. Paying on time is key. It's not just about having a mix of credit, it's about managing that mix responsibly. And here's a little nudge. If you're finding our discussions helpful, do hit that like button and subscribe to our channel. We've got a lot more to share. Ultimately, building a diverse credit mix is not a quick fix, but a long-term strategy. It's part of a bigger picture of responsible credit management. Before we tie things up, let's take a moment to review what we've discovered today. Our discussion centered around the significance of a varied credit mix, the necessity of managing your credit with responsibility, and the essentiality of comprehending your financial capability. Despite highlighting the relevance of credit mix, we've underscored that it's just one aspect of your overall credit score. Other aspects like timely debt settlement and keeping a low credit utilization ratio are just as vital. The aim here is not to find a one-size-fits-all solution in credit mix diversification, but to comprehend your financial capability and make decisions based on your unique circumstance. So, game plan to diversify your credit mix. How are these decisions aligning with your overarching financial strategy? We'd love to hear your thoughts. Share them in the comments section below. Our discussion continues. Moving forward on this enlightening financial journey, we extend an invitation to you to become an integral part of our community. If what we've discussed today has piqued your curiosity, think about joining us. By doing so, you'll acquire a vast amount of knowledge that will equip you to make more informed financial decisions. Staying updated with our latest content is not merely about gaining new information, but it also gifts you the chance to interact with a community of similar thinkers who are dedicated to enhancing their financial health. So, why should you wait? Advance to the next stage in your financial journey. Join us now, and together we can continue to learn, grow, and prosper. As we delve deeper into the fascinating world of credit mix, we encourage you to engage with our community. Your thoughts, experiences, and insights into this topic are invaluable. The financial journey is a shared one, and through our collective wisdom, we can navigate it more effectively. Don't hesitate to drop your comments, share your own tips and tricks, or even ask questions. The terrain of finance always presents a lesson to be learned. If you're enthusiastic about expanding your collection of financial wisdom, consider subscribing to our channel. By doing so, you'll always be one step ahead in knowing about our new releases, and you won't miss any key financial discoveries. To subscribe, just click on the red subscribe below the video. Additionally, don't forget to hit the notification bell. This guarantees that you'll be notified each time we publish fresh content.